Hello and welcome to the Lolly Investor Programme. This week I'm at the almost completed Olympic Park in the east of London, where in a few weeks' time the world's best athletes will compete. Now, I'm not saying these videos are going to turn you into investment superstars, but hopefully they will help you make your money fitter, work harder for you. Today I'm going to introduce you to the investment fund and how it can help you invest in shares and bonds and property. In other words, some of the asset classes we've been looking at recently. But let me take a step back. If you wanted to invest in any of these areas by yourself, you could. Using the internet, it's become a lot easier for private investors to buy shares and property, although commercial property probably remains out of reach. Nevertheless, it remains the case that to be a successful DIY investor takes quite a lot of money, experience and time to do well. However, investing in a fund can take the hassle out of investing. It means your money can go a lot further, although you do have to be careful about which funds you pick. A fund takes the money from lots of different investors, pools it all together and then invests it in far more places than an individual could do on their own. It's a bit like being able to back all the world-class athletes at the Olympics in one go rather than having to pick out 2 or 3 on your own. A fund is run by an investment management company that employs people to either pick out the best and most athletic investments they can find or to track a particular stock market index such as the FTSE 100. There are literally thousands of different funds buying into shares and bonds and property both in the UK and overseas. Fund managers are a bit like athletes. Some are much faster, can jump far higher and do a much better job than others. In the coming weeks, I'll tell you more about how funds work and how you can choose the best ones. For now, all you need to know is that there are 3 main types of investment fund. There are unit trusts, in which you buy units in a fund. The unit price goes up and down in accordance with the value of the investments held by the fund. Then there are investment trusts. These are companies in their own right, which go around buying shares and bonds in other companies. Rather than buying a unit, investors buy a share, which also moves up and down, hopefully more up than down. Lastly, there are exchange-traded funds, which specialise in tracking specific stock market indices like the FTSE 100. Next week, when we go into our second round of our investment fund coverage, I'll tell you all you need to know about unit trusts.